The spectacular falling out between President Trump and Elon Musk shakes the markets. Tesla lost $150 billion in market value on Thursday, a 14% drop, as CEO Elon Musk and President Trump traded insults on social media, and the president threatened to cut billions of dollars in government contracts to Musk's companies. There has been wider fallout for markets, with other investments that have risen on the back of Trump's support, like Bitcoin, also falling. Ethan Devitt is a senior investment advisor at Moneta. Ethan, Tesla shares are rising again in the pre-market after reports that White House aides have scheduled a call between Trump and Musk. But from investors' perspective, can Tesla's credibility recover?
I think so. I mean, let's look back at why we had this spat. It's essentially because Elon Musk has left the administration. Why did he leave? He was being called back by market dynamics to his company, and he was committed, he said, to turning that around and to getting the sales going and basically getting it back to where it used to be. So I would say this spat is in one way somewhat good news for the shares. I think any news that is this dramatic is going to have an effect, as we've seen. And just like we've seen in the trade negotiations, on again, off again is the norm. Big bang and then reining back from that is the norm. So maybe that's what we're seeing in this spat, although it has got a little personal quite early.
Is it telling the wider market, though, to be careful about betting on President Trump's long-term support for anything?
I think that's already been factored in, honestly. I think we've seen that there is quite a bit of divergence between, say, Republican dogma and where this president sits. He is, at his core, a populist, and a popularist is another word I've seen used relating to him. He will move with where the popular opinion goes and what makes him look good and really resonates with his base. So I think that there is already very much a short-termism that has come into estimates. And as we know, with companies such as Walmart and Apple that have fallen under the rhetoric just in the past few weeks, and there is I wouldn't say there's much loyalty to any particular cause.
In more traditional market-moving news, of course, the jobs report is out later today. Do you think the recent instability around trade will start to feed into the US labour market?
I think it's too early. It is a lagging indicator. We haven't seen any sort of massive reductions in force at this time, although we do hear about it from time to time. We've seen labour being quite stable, I'd say, and some small changes at the margin. It does get revised backwards from time to time. So I'd say nothing big bang coming out of that. We're still dealing with a bit of a dispersion between hard data and soft data in the form of sentiment. Sentiment has been swinging quite a bit, and it's very hard to get a handle on that. But I'd say no surprises from jobs.
If that's true then, if the labour market looks fairly stable, what could that mean for the Fed? Might it stay put for the rest of the year even?
I'm not so sure about the rest of the year. I think for now they're getting intense pressure. They're seeing the rest of the world get on their monetary easing bandwagon. We've seen 8 cuts out of the ECB, 4 out of the Bank of England, and we know that they're quite confident in their inflation figures. So if the Fed can just really figure out what trade negotiations actually mean for inflation, I think they are poised to cut. I would see 1 or 2 cuts by the end of the year. We still have a full half of the year to run. I'm not sure the employment picture will do it, but certainly some real signs of eroding sentiment and economic activity will do it.
Talking of eroding sentiment, we're still seeing a lot of nerves in longer-dated US Treasury yields, aren't we, as Republicans' big, beautiful bill makes its way through Congress. How concerned should markets be about that?
I think reasonably concerned. The bond market has called the errors in judgment, perhaps, or some of the loopholes in some policy for some time. They have always been focused on the downside, much more so than equity markets, which have tended to buy the hope story. So bond markets have been really the canary in the coal mine. And as we see these yields creep upwards and stay there, what we know is it says something about technical demand, about where the non-US buyers are finding their risk-off assets. And equally, it's a sign that really bond markets are not second-guessing this administration and the big, beautiful bill when it comes to its inevitable impact on the deficit. So there is concern there. I think Scott Bessent is focused on that very carefully. And that may well be the trigger that leads us to see more and more capitulation when it comes to some of these trade positions.
We've had a lot of talk about institutional investors in particular moving money out of US assets in general, but of course longer dated bond yields are also seeing this sell-off in other major economies like the UK and Japan. So which is it, a move out of US assets or a move out of longer dated government debt in general?
I think it's a little bit of both. We did see that contagion effect when we saw the massive sell-off in the US Treasuries, and it seemed a little unfair for other countries who'd been wrestling with their own issues but didn't need really that additional leg down. So there is clearly a lack of confidence in fiscal rectitude. I think we're seeing a lot more less use of the fiscal brake, more kind of I suppose, complacent attitude to deficits, and that is creating some concern. There is, however, on the margin, definitely an exodus from US assets, particularly from non-US holders. We've seen that with the dollar down 8% against sterling year to date. We know that that is likely to be a sticky thing. And equally, the demand for treasuries is probably a factor of non-US holders finding their risk-off assets elsewhere.
That was Ethan Devitt of Moneta. Don't forget, you can watch more videos on Reuters.com.